Sometimes Forex trading can be a wild and woolly place to be. But Forex trading doesn't have to be the Badlands for you, partner. Instead, hunker down and bend your ear. You'll be burning the breeze in no time here at the Truth About FX podcast.
Welcome, it's Walter here. Today we have Adam Hartley. Adam's been programming for over 20 years. He has a doctorate in physics and he's got quite a background in programming. So it's going to be an interesting conversation, I think, because Adam's going to shed a little bit of light on the algo boogies, perhaps, and what it's like to work for hedge funds. So welcome, Adam.
Hi there, Walter. How are you?
Yeah, great. So Adam, this is really interesting because there aren't a lot of people like you out there who are willing to talk. So I'm just curious about your background. How is it that you went from physics into essentially programming algorithms? How did you make that jump? I suppose, what's your story? Like, how did you get to where you are today?
Sure. Well, as you said, I started off in academia. I was studying physics, doing my doctorate in physics, and there's always this thing hanging over you is where the next bit of money is going to coming from as an academic. And I was starting to worry, what would I do if the funding ran out, because I was enjoying the physics. And so I and I've always been quite interested in the market. So I started to think, well, maybe I could sort of figure out the markets. How hard can it be? So I started to get a bit interested in it, read some books, and started to code up a few little simple indicators, really basic stuff back then. I just really got into it. I got more and more addicted to it, or I wanted to work out how it worked, and it didn't seem as easy as I thought. I tried doing a bit of spread betting back then, and with the predictable results, losing money, but I thought there must be some way of doing this. Spread betting didn't go well, and then the money did run out, and so I took a programming job with as some guy in one of the neighbouring departments to set up some little spin-off companies. I did that, and I was bored, rigid, hated it. But I started developing various contacts from the finance world, and I eventually decided, I would really like to work for myself, and I would like to, I got my programming skills, I got my interest in finance. I discovered a program called TradeStation, which is very good for sort of programming stuff and testing, back testing. And I also have been developing a little charting package. I've got a little handheld pager called a futures pager, which will broadcast sort of updates of the markets every sort of 30 seconds to a minute. And I wrote an interface to it, and so I developed this little simple charting package. So eventually, it was around about 1994, I took the plunge and started working for myself. And so and basically, I've been doing that ever since. My sort of clientele vary from sort of retail traders all the way up to sort of big institutions. I do whatever serious people wanted me to do, whether it's just programming up an indicator or selling my charting stuff. Sometimes it was doing serious back testing for large funds and things. And so I've started doing that, and I just progressed, and I've made a comfortable living from doing that. And I carried on doing that for quite a number of years, and then gradually things started to get a bit harder to make a living. And that's partly, I think, because globalization, really. There's a lot of really cheap, good programmers in sort of Eastern Europe and Asia who came online who do it for far less than I would. And so the work started to dry up a bit, but then I met a guy here in Oxford who was just starting to develop trading strategies for a fund. And he was looking for a programmer, and so I came on board and joined him. And it turned out he's working for the Tudor Group, the Paul Tudor Jones fund. And so we worked together developing strategies for Tudor, and that went on for 10 years actually, and it was a very successful collaboration. So we ended up designing some really quite long-term trend following strategies, which Tudor, at the peak, they traded over 800 million with our stuff, and we get sort of a small performance and a management fee for that, and that worked very well for a long time. And then unfortunately, trend following hit a bit of a rough patch towards the end of the last decade, and the relationship with Tudor came to an end. And so I went back to doing the research and programming and things like that. And I've always wanted to trade. And the thing that actually got me interested in this whole business was, as I said at the beginning, wanting to know how to trade so I could perhaps finance myself. And so I've always been on the side trying to work out how to trade, and I discovered the Naked Forex Now forum and got really involved in that, and it was great to learn out all sorts of different new strategies from that and meet up with all sorts of fellow traders and things. And so that's been one of the things I've been pursuing alongside the programming is trying to get to the stage where I'm actually a successful professional, and so that's basically where I am now.
Okay, so one of the interesting things that I've heard you mention, I think it was on the forum at Naked Forex Now, but I'm not certain. I think that's where I read you were saying that you found that it's easier for you to program an automated system that's a trend following system than some other sort of system. So I suppose if that's true, then you'd be comparing that to like a mean reversion or a breakout or something like that. Or can you explain that? Because I found that to be an interesting comment. If you did indeed say that.
No, I did indeed say that, and I'll explain. I found when working on the sort of the Tudor years, as it were, we developed a lot of strategies, and I mean there had certain constraints in that we had, they had to be big enough to manage millions of dollars. So we couldn't do the sort of little small finicky stuff. But it was very hard to find something purely mechanical, which you could purely rule-based, has someone which would actually make money consistently. And we found that very often we have some idea, and then you tweak the parameters and sort of optimize or let it, find out where it works best. And the system would always morph in the end into a trend-following one. And the reason for this is one of the most enduring edges in the market is the long-term trend. I mean, if you sort of, trends over perhaps 6 months thing, relatively easy to make systems which will exploit that edge and will make money. And it seems like there's, other edges come and go. In terms of one of the most consistent edges which will endure, it tends to be trend following, and I know that there are other methods out there, but they tend to, as I said, they tend to come and go, and they're actually very hard to get something that works well consistently over a long period of time. And I'm talking about a long period of time, 10 plus years sort of thing. So basically, it's hard developing purely mechanical stuff, and one of the few things that will work is trend following. So it's to be done on quite a long-term time frame, which is probably far longer than most people most retail traders are going to be interested in.
So when you say on a long-term time frame, you mean the system is programmed to work, say, on the monthly charts or something like that? Is that what you mean, or you mean is there something else that you're referring to, like a 100-day look back or something like that? I don't know.
Yeah, something like a 100-day look back. It's that sort of order of magnitude actually. It doesn't have to be on a monthly time frame. Most of our stuff is on daily time frame. Yeah. But it would be a sort of big look back, and holding trades for. Could be long for several months sometimes. So that's what I mean by that. Yeah,
interesting, because I recall readings. I think it was Richard Dennis, and he had some. Richard Dennis, as we all know, is in the Market Wizards book, and I think the Turtles experiment and all that. And I think he had some sort of bad patch, and they interviewed him. He was interviewed again after the Market Wizards, and it might have been in the second Market Wizards or something like that. The point was that he said, what we found was that we had to change time frames. Like you had to go much further out or go much lower, time frame to because everyone, essentially it was like everyone was basically trading 21-day breakouts or something like that, to copy what the Turtles were doing or something like that. I don't know exactly, but I recall he was saying essentially we had to drop it down and look at the lower time frames or go zoom way out. Is that something that you found also, that you can, like, for example, can you trade 200 candle look backs on the 5-minute chart or something like that, or is that not something that you've looked into? Or I'm sure, I suppose you had plenty of time to play with a lot of data when you're back in the Tudor days, right?
Yes, well, we looked at all sorts of things. We didn't generally look at 5-minute charts just because of the issues of trying to put on $50 million worth on a 5-minute chart, admittedly spread across markets, but still, execution was a big deal. That's one of the things that people don't realize, is that when you're managing 800 million, actually trying to put the position on when you think the trend has changed becomes an issue. And Tudor had this rule that they wouldn't trade a market if the volume they were trying to do was more than 15% of the total volume of the day. But quite often it was approaching that, so that tells you how big some of the sizes were.
Yeah.
But in answer to your question about the moving sort of sweet spot, as it were, in the optimization, that is, unfortunately, does seem to be the nature of financial markets. I mean, in a perfect world, we'd be able to model these things, and there's one ideal look back, and you trade it, you optimize it in the past, and it works well, and he's there, ever more going forward, and we'd all be millionaires if that were the case. But unfortunately, this this optimal parameter, this length that you might be trading for a trend following, tends to move around, just like Richard Dennis found, and this is there's a optimizing, fitting parameters for a system is a bit of a dark art, really. And one of the conclusions that we basically came to is that firstly, the fewer parameters you have, the better, because this bugbear of curve fitting is such a huge thing. It's far more than you think, So we'd ideally like to have one parameter, and even then would try and do is diversify across that one parameter. So, if the trend length was optimally, say, 8 months or something like that, we might trade 3 months, 6 months, 9 months, and 12 months to just try and remove even the dependence on that. So, you're trading huge combinations of different trend lengths. We're trading 60 to 80 markets, so it's a huge matrix there of things being traded. But what happens is, what emerges from this huge conglomeration of orders is that there's a small but persistent edge, which you find that at the end of the month you're up a few percent, and that you just grind it out like that. But yes, the sweet spot, as it's called, they'll certainly move around all the time.
Right. And do you find that changing the exit parameters or the exit rules is something that has been fruitful? So regardless of the entry, like for example, you had those 5 different entries or whatever, 100-day high or whatever, 500-day high or whatever, something like that. And then does the exit make much difference in your results in general?
Well, the kind of stuff that we were typically doing, especially for long-term trend following. So I know the turtle strategy, what you do, you have one length for going in, like 20 days, and something like the 10-day to exit. So you do actually have a period where you're flat. The kind of stuff we would be doing would be more like you're going long on the 20-day breakout and you use reverse to short on the 20-day breakout. So there wasn't really so much as an exit parameter as a reversal parameter, which was just, so it's just when you're not long, you're short sort of thing. And that tended to work reasonably well for that particular type of strategy. Now, I know that there is a school of thought that the entries don't even matter, and it's the exits that are important. And I actually think I do subscribe to that. Certainly for one of our trend following things, the entry was virtually random, but it's how you manage the trade which made the difference. In that if you're trying to capture a long-term trend, you made sure you got out fairly quickly if it started going against you, but you'd hold it for up to 6 months if it was going in your favor, sort of thing. So there is that aspect to it. Yes.
Yeah, I need you to I need to record that and send that to some trading students, because they'll argue that point. But I think that's interesting, because what you're saying essentially is it makes a lot of sense to cut your losers quickly and really try and hold your winners as long as you can. I mean, really, that's essentially what you're saying, isn't it?
Yes, I mean, it is what I'm saying for that particular type of strategy, and I think for many people that is a very successful way of trading. But it's also, many people find it very difficult because the psychological aspects are against you in 2 respects, in that we don't like losers. So instead of cutting our losers short, we tend to sort of do the opposite, and then we also we like taking our profits quickly because they're there on the table. So psychologically, we're biased against both sides of that equation, but it is a good way of trading in general, and there's some very successful people. I don't know if you come across a guy called Chris Capri. He has a course, Second Skies, but it's basically, his style is all about that. It's about risking 1 arb, is routinely taking 4 or 5 arb, and it's cutting his losses short and letting his profits run. It's a great way of trading if you can get it to work for you.
Yeah, it's interesting, because I think you're right. You're absolutely right. Psychologically, we feel more comfortable adding to a losing position because we want to be right, not because, logically the math works out. If you get rid of those problem children and just hold on to the ones that are behaving, then eventually you're going to have a great family, right? But what happens is, oftentimes we just want to add, if it was a good buy at that price and it's fallen 150 pips, it's an even better buy now. We just want to be right, and it's a difficult thing to break through. Is that something that you're? I mean, it sounds like that's essentially what you're hinting at in terms of the psychology of the trader.
In terms of the psychology, yes, it is. It's exactly right. In that there's something very alluring about doubling down on a loser, because it only has to go back half as much now for you to at least scratch your trade, and if it keeps going, you're actually sort of doing very nicely. But it's the road to hell is paved with good intentions, as they say. It's a bad way of trading in general. So it's the thing about trading is so fascinating is our psychology is in general dead against doing what's right for trading. We have to do the opposite of what our instincts in general tell us. It's what makes it so challenging.
Yeah, it's exactly right. That's why as a new trader, your gut instinct is going to always tell you the wrong thing to do. I mean, and actually, even as an experienced trader, your gut instinct will often tell you the wrong thing to do. But at least you're aware that your gut instinct is often wrong.
Exactly. Yes. No. It's one of these things you have to learn to go against. Basically, it just comes with experience, I think, and just having loser after loser handed to you on a plate, you suddenly start thinking, "Well, hang on a moment, maybe I shouldn't be doing this."
Yeah. Yeah, exactly.
We get there in the end. Well, hopefully. Many people don't, sadly. I mean, the thing about trading is that many people give up before they learn.
And so, okay, so when you're doing currently, you have, I suppose, currently now you have some of your own systems that you've created and that you're currently trading, or that you're sort of babysitting these algos, or is that not part of your trading? Are you discretionary and sort of semi-automated or fully automated systems?
It's interesting because everyone is always amazed that someone like me, with my programming ability, and I can write EAs with my eyes closed virtually, that I don't do more algorithmic trading. And the truth is, from all my years of programming, it is really hard coming up with stuff which is purely automated, which is entirely rule-based and makes money. And I actually think the truth is the best edges are to be found by having some kind of simple setup, which you could program up, but then it's the discretion as to when you use it is the edge that makes you the money. I mean, if you take something like Jorge's 2E system, which we have in the forum, it's a very simple setup. It's easy enough to program up the rules. There's no sort of doubt about when you've got a 2E setup, and how he manages the trades are all program all that up. I could write an EA, no problem. But the reason why he makes money on it, and the reason why a completely automated EA doesn't make money, is because he chooses very carefully the market conditions and which setups he'll take. It's very interesting listening to his videos. He'll say, this setup looks a bit weird, I'm not going to take it, and then occasionally he likes one and he takes it, and that's why he makes money. And I can't get around this at the moment. The fact that it is really hard to find purely automated stuff which actually does make money. Now, it is possible. There are sort of funds out there are doing, and I have, through my work over the years, come across certain outfits which do manage to do it. There's a guy I'm working with at the moment who has a purely automated genetic algorithm optimizing thing, and he makes 2 or 3% a month with nice low drawdowns, and grinds it out. And there's another guy who's got this incredibly complicated real-time analysis of the U.S. stock markets, and doing all this stuff in real time, and he very occasionally trades, and his performance is phenomenal. He makes 30 to 50% a year with drawdowns about 2%. It's just insane. But sadly, these examples are few and far between, and it's not easy to make something purely automated. So in answer to your question, I am actually more interested in discretionary trading. In fact, at the moment, I'm looking into a scalping approach, which I've come across, which I've actually found it suits my style, and I can actually make money using it. But it's not automated by any means. Right.
Do you think that, because I've often wondered this, do you think that one of the reasons why it's difficult to program a profitable system for many traders and programmers is because that there is something that the trader is looking at or analyzing it's not really being articulated, so therefore it doesn't make it into the code. For example, like your Jorge example, when he trades these trends with the 2E system, there may be something that he recognizes in the charts, but it's not something that he would tell you he's looking at when you were to write down the rules of the system.
Yes, I think you're right, and it's, as I said, the rules of the setup are obvious, and you can write those down. But the other things which he's looking at, I mean, even if he told you, it's the nature of how the bars before are hanging together, where the nearest support and resistance is, how much of a strong the trend is, how choppy it is, all those kind of things, which, I mean, even if you could articulate them, and I'm sure Jorge could, the difficulty is actually coding stuff like that up. That's really hard, and that's why it's very easy to code up something like a moving average is crossed over, because that's obvious and there's no debate about it. But, is the trend strong enough? You could possibly come up with some rules for that, or, where the nearest support and resistance is. That's getting hard, because picking out support and resistance stuff is not an easy thing, because we do it by, we eyeball the chart and say, well, it's here and things, but actually programming that up is hard, and it's that reading the market tone and all that kind of stuff. It's just so hard to come up with a purely automated objective way of doing it, and it's that sort of intuition we have, or that just coming with experience, that way of reading the markets. That's the difficult bit. If we could do that fully automated, then it would the whole thing would be relatively easy.
Right. I like the idea of semi-automated. I mean, I've done quite a bit of that over the couple of years. Just sort of, I will use discretion to determine which market I'm going to trade, and then I just turn on the setup for a system that I like to trade. But I don't know that I could articulate very well the rules that I'm using to essentially filter out different markets. So I suppose that sort of fits. Is there something that you would say as a trader and as a programmer and someone with your experience that you've noticed when people go down this path that they often make the same mistake, or there's a set of mistakes? For example, maybe they over optimize, so they have too many parameters. So they have perhaps they have too many parameters, or they over optimize, or they don't use like an in sample out sample data, to confirm that what's going on is going to work in an out of sample data, or they don't use walk forward analysis. Or is there something that you can say, look, definitely this is one thing or two things or three things that you should look at this when you're building an automated system?
Yes, I would think some of the things you touched on there are actually quite important, but I would say that in general, if looking at the biggest picture, the issue to do with doing fully automated stuff, and it's something I touched on earlier, is that the goalposts keep moving, in that you can come up with something and you optimize it over the last couple of years or something like that, and you think, yeah, this works really nicely, and great, lovely backtest equity curve, and then what happens is the market just seems to shift slightly in the way it behaves, and that sort of setup which worked so perfectly in the past suddenly doesn't work anymore. And and I find, as a general rule of thumb, the shorter term the stuff you're doing, I think the more prone the market is to this. My business partner and I used to talk about a paradigm shift. The markets would undergo a paradigm shift like this, and suddenly it would no longer behave in this way. And there may be some underlying fundamentals which have led to this shift, or it could just be people. There are people out there spending their whole time analyzing the markets, and if they too have spotted this same little edge, they'll be exploiting it. And the edge will soon disappear. So that's sort of the biggest picture thing. But going around to more detail, for sure you need to have an in-sample, out-of-sample testing, and overfitting it's so alluring to be able to add one more parameter and suddenly everything looks a lot better. But you've got to ask yourself whether that is actually predicting anything, or whether you're just fitting to the backtest data. And it's a very easy trap to fall into. So it's not easy, but coming up with fully automated things. But I was just going back to what you touched on about sort of sometimes switching on an EA and using it. I mean, I have EAs for managing trailing stop, for example. So I put some setups I use. There's I'm in this position, and then it's just going to manage a trading stop. I just drop an EA on it, and I just waver and always let it do its business. So I think there's a great believer in automating the bits that can be automated. I also personally believe that it's very hard to find something that's fully automated, and if you like, you need a discretionary overlay on top of it to know when to use your EA and when not to trade at all, that kind of thing. Right.
Interesting. So in your current trading, when you're trading your scalping system, is that something that you would do? You're in a position that's profitable. You might drop the EA on there and just let the trailing exit take that trade out or something like that. Is that kind of your approach?
Yeah. So I've used a couple of setups in the scalping thing. One of the things I'm still developing, but it's almost like a big shadow on 5-minute charts. If looking for big impulsive moves, and you want to get in on those and have some kind of trailing exit. And so it's certainly something I'll do for that particular type of setup. No, I mean, scalping in general is more than a few pips when you've got it, rather than trailing things. But I do have a one particular strategy, which is say this impulse trade, where I will indeed drop a trailing exit on it and just leave it. So.
Right, and so right now in your trading, which time frames are you focusing on? Do you focus on the 1 hour charts or the daily charts, or how do you? Well, I suppose it depends on what the markets are doing, which ones you will spend time on. But in a typical day or a typical week, what will you be looking at?
As I said, I'm very interested in scalping at the moment, and that's all done on a 5-minute chart. I've been quite influenced by a chap called David Franklin, who is he's a professional scalper. He makes a very nice living from it, and he's very willing to share. And so he's been he believes in paying it forward. So he's been sort of helping out a number of people who are interested in it. Now, I've always been drawn to the short-term time frame. It just suits my mentality. I like the sort of the instant feedback you get with short-term stuff. And I know that for many people, they're not suited to short time frames, and I know you've mentioned how studies have shown that sort of trading on sort of short-term, 1 minute, 5-minute bar charts lights up the addiction area in your brain and things like that. And that's certainly not going to be for everyone. But personally, I very much enjoy trading off 5-minute charts, and I find I can be more consistent doing that than many other things that I've looked at.
Wow, that's fascinating. So that's pretty much your preferred time frame then. Wow.
It is at the moment, yes. So this particular strategy I'm using is a 5-minute bar chart scalping approach.
Right.
And you just switch on the charts each day, and you follow your 5-minute charts and look for those little setups and things like that, and away you go.
Right. Excellent. So do you have certain? I'm just curious. Do you have certain rules in terms of you can only have so many? Like if you had, say, 2 losers per day, then you're out. That's it for your day. Or do you have sort of risk parameters that would get you out of a really poor day or something like that?
Yes. In fact, David Franklin himself, I'll just give you a bit of a background to what David does. Is typically looking for 3 to 5 pips, so very small little scalps like that, and his stop loss initially could actually be quite large, but something like 15 pips maybe. Though he will, if he finds himself on the wrong side of a trade, he will often bail out early. But he has a rule that 3 losers of any size, and he's done for the day, he'll stop, because this with sort of inverted risk-reward type of trading, a loser has such a disproportionate impact. But he's doing 30 to 50 trades a day sort of thing, and he may well not have a loser at all. He's been doing it 5 or 6 years, as I think I said, and he's very consistent up to the day. So, and personally, yes, if I have 2 big losers, I'd certainly stop for the day. Yes, because one of the things I like about scalping is, as I said, the whole process is very accelerated. In that, in trading, we've got to learn. It's all about balancing the risk reward against the hit rate, and also it's ultimately about our own psychology. It's about what's going on in our heads, which is getting in the way of making the profits. And the thing I like about the scalping thing is that whole process is very quick, in that you can have 10 trades in a 2-hour session, and you can have your loser. It's staring you in the face. You've taken that emotional hit, and so a large part of what I'm doing while I'm trading, while I'm doing the scalping, I'm spending all my time monitoring my emotional state. And if I find myself out of kilter, then I will not take any more trades, because I just know that I can't think straight like that. So it's a very sort of speeded up version of trading. If you're trading on a 4-hour chart and you've taken a loss, you've got 4 hours to recover before you even need to think again about the next trade. Whereas here you might have 5 minutes. So it's a whole new ball game.
Yeah. I would think that you'd have to fight against the revenge sort of thing. Oh, I lost last time. I'm going to get you back. You got me for 9 pips last time. Yeah.
Yeah. No, revenge. No, that's a real killer. The revenge trade. And you really do need to be objective about it. But I think the thing is that is there on all time frames. I know you have, as I said, you have 4 hours to recover or whatever. But it still hangs over you. On my last trade, I was a loser. I've got to make that back somehow, and I know personally it's a great stumbling block for me. Is that to do with revenge trading, and I've done your fantastic "You Get What You Trade For" course in the Naked Forex Now forum, and I know what my psychological buttons are that when they get pushed, I don't behave rationally, and one of them happens to be having stuff taken away from me, and it's it all stems from childhood, and it's nothing particularly big that happened to me, but I remember a few incidents when I was in nursery school and first school, some boy taking something away from me, and my parents would sometimes fine me for doing something, or and it's just I had issues to do with stuff being taken away from me, so I'm very aware of this in terms of revenge trading. If I have a loser, I felt like it's been taken away from me, and then I've got to make sure it's then not resonating with that past issue and making me trade irrationally to try and get it back and try and fill that emotional hole, which is obviously you've got to be dispassionate and objective about your trading. So but I like we've got to work our way through these things. There's no getting around it. If you want to be successful as a trader, you have to work through all the stuff so it's no longer an influence. And the thing I love about the scalping is that whole process of working through it and sort of seeing these things happens on a much faster timescale. You may get 2 trades a week on your 4-hour charts. I'm getting 10, 20 trades in 2 hours, so you get plenty of opportunities to address these issues.
Yeah, that's interesting. Do you find that when you start making money on the quick trades, the scalping trades, do you find that your broker starts to slip you in funny business like that? Do you see that happening?
Not personally, because rule 1 for me of scalping is you have to use an ECN broker, a proper ECN broker. So it's got to be a broker platform which has multiple contributors who are all providing liquidity, and the broker is just taking a commission. Because otherwise there's this inherent conflict of interest between your broker and you. And as you say, no broker's going to, if the broker's taking the other side of your trade and you start making money, he's going to do something about it, because that's his livelihood you're taking there. So you have to, for this kind of trading, use an ECN broker. And, fortunately there are quite a few good ones out there. But, that's rule 1. I mean, don't even attempt scalping with that unless you've got that, in my book. Yeah,
that's great advice, yeah. Okay, so it's interesting because you're by far the expert at drawing up automated trading systems, and yet here we are talking about discretionary scalping.
Well, I know people are always amazed at this. Is how come someone like me so drawn to this discretionary side of it? And I don't know. I wonder whether there's some underlying psychological thing behind it. I don't know. There might be, but certainly, it's not for want of trying. In terms of purely mechanical stuff, I think now that I'm thinking on the fly here, but actually, now that you mention it, there are purely mechanical things you can get to work. There's things like opening range breakout stuff. I think this guy in the Naked Forex Now forum had some Asian range breakout things, and you backtest those things. They do make money, but the problem with all purely mechanical trading strategies is that they do have periods when they don't work very well. They have these long periods of drawdown, and I think you've got to either decide you're going to be a purely mechanical trader, in which case you're just going to have to sit through those drawdowns, or you're going to have to go down the discretionary route. And personally, I've always found it uncomfortable sitting through. I mean, everyone doesn't like drawdowns, but I've always found it uncomfortable sitting through these drawdowns, and I've always been looking for this holy grail of something that's consistently making money, so you don't have to endure this. And so that's personally why I've been drawn to the discretionary side, is to try and get out from those sort of the drawdowns you get on a mechanical scale.
Right. What about reversion to the mean style trading? Typically those have, they still have drawdowns, but they can have fairly, nice looking equity curves, right?
Yeah, there are outfits who purely algo outfits who do this reversion to mean stuff on a vast scale, but even they struggle on it. And I think there's something very alluring psychologically about trading reversion to the mean. And I think the Turtle guys called it the call of the counter trend. It's very, very alluring, but I don't think that's where the edge is. If you test these things, and I've yet to see a decent counter trend system which actually holds up. I mean, there's all this sort of grid trading nonsense out there, which is very alluring, because it seems like it almost never loses money until the one time when the market just keeps on going, and then it will wipe out your account. And that's not a bet I'm willing to take, in that winning most of the time but risking wiping out my account. So certainly that grid trading stuff is a non-starter. But and there are some people who successfully trade counter trend, and I would say that just like in all trading, it's the discretionary overlay which makes the difference, in that these people are carefully picking their levels where they're doing this. They're managing the trade right. They know from experience how much they can push it and all that kind of thing. And I'm absolutely certain that can be made to work just as sort of trend following type of stuff can be made to work. But it's not necessarily any easier an option. I think that there's no doubt that there are underlying trend biases in the market, because that's basically what our long-term hedge fund stuff relied on in the end. So those biases are there, and if you look at the distribution of the market returns, they all have this so-called fat tails, which basically means the market will tend to move more than you might think it would if it was random. And I know Darren is another person in the Naked Forex Now forum, a very successful trader. He's always going on about the levy flight distribution, how markets are like this. They'll just occasionally move further for longer than you think. And all this tends to tell you that you ought to be really trading on the trend side rather than on the counter trend side. For me, anyway. I'll say it's one of these psychological biases, but some people will be drawn to the counter trend, and no doubt some people can make it work. But it's certainly not for me personally.
Yeah, exactly. If you know what sort of distributions you're going to see when you're looking at trade results in the markets, it makes a lot of sense to use a trailing exit. At least then you're going to know that you get a really big, huge winner who comes into your equation and bumps up your average winner, right? That's basically what you're looking for.
Absolutely, yes. I mean, those occasional big winners can make all the difference. I mean, there's some strategies which rely entirely on just the occasional huge winner to make them profitable.
Yeah, I love the trailing exits. I love you can even do it without a trailing exit. You can have an aggressive target. But the point is, if you're using a trailing exit, in theory, you're allowing the market to go as far as it wants to go, but it can be difficult to trade it this way.
Yeah, of course, they're quite psychologically, they're quite difficult to trade because, so many times you're sitting on a modest profit and only to give it all back and you ended up with nothing. So it's quite difficult, but if you're prepared to sit on your hands, and occasionally you'll catch a huge winner, which hopefully makes up for all those times when you gave it all back. So, that's the psychological trade-off, really.
Yes, it is difficult, I agree, but there are a couple of interesting points. Okay, so listening to what you have to say here, Adam, I know that it's easier for many traders to trade a higher win rate. And I know this, I've tested traders around the world, and most traders kind of focus in on this. So it's easier psychologically to do that. But that's kind of the allure of scalping, isn't it? You really have to be careful when you're scalping because, one, you've got to keep your win rate high. Otherwise, you get into trouble in terms of making money. And then secondly, you have to pick your broker very carefully, as you know, because as soon as your broker knows what you're up to, it's very easy to them, if they're a market maker, to make it easier for them to steal from you and make it difficult for you to make money. And in fact, a lot of ECNs that are out there, they claim to be ECNs, but they're not true ECNs. People don't realize this, and they think that they're going to go and see, oh, it's an ECN. Okay, great, I'll go with this broker. But it's not that simple. Can you talk a little bit about that, about how you discern between a broker that you are comfortable with scalping versus those that you should definitely stay away from if you're just looking to make a few pips here and there with your trading? In other words, how do we spot a true ECN?
How to spot an ECN? Yes, that's a good question, Walter. Well, I think with some brokers, you can actually look at the depth of market, and it even shows you the name of the bank providing the liquidity for each price. I know if you use interactive brokers, for example, then you can actually see all the contributing banks and, so it's all the big names, and so you know that it's definitely an ECN. If you're using something like MetaTrader, on the other hand, though, then you don't get that. Transparency. You can't actually see who's providing the quotes. You can sort of tell by looking at how the prices jump around and also how tight they are. But probably the simplest way of picking out a reliable broker is actually by word of mouth. And that's one of the great things of something like the forum, the Naked Forex Now forum, is that there's plenty of people around there to ask, and they'll tell you what brokers they recommend. It's one of these regular topics that comes up all the time. So there's a few ECN brokers that I recommend. If you look in the forum, you can see which ones they are. So that's probably the best way I'd go about choosing a broker then.
Yeah, exactly. Thank you so much, Adam, for spending time with us here today. I'm looking forward to hearing your presentation at the conference. And, somebody with such a wealth of experience working for hedge funds, trading yourself, and having that background in psychology, I think it's going to be a great presentation for those that are able to attend. And I really appreciate your time. Thanks so much, and we'll see you at the conference.
Okay, bye.